is the red line that you see at the end is the recently completed year. And if you look at the line, I thought that it would match up with 2008 foreclosure crisis sales activity, but it was a couple of decimal points lower. So it went all the way to 1995. Population back then, 70 million fewer Americans. So 70 million more Americans today, yet home sales at that level. And it's 2 consecutive years of declines. It was 18% decline in 2022, now 19% decline. But fortunately, we are off to a better start this year. Application to take out a mortgage, which is one of the first step for home buying process, is already picking up. And that is picking up because, as we know, mortgage rate today is better than 2 months ago. 2 months ago, mortgage rates averaging 8%. That's the average rate. We know that some clients pay more, other clients pay less, depending on their credit scores and down payment and other factors that go into it. But average mortgage rate was 8%. Well, today it is under 7%. So that has already stirred interest among buyers. Let's look at home builders. Home builders, December figure is not yet in, but once it's in, it's going to show an increase. This is an amazing divergence between what realtors have been facing. Realtors were challenged, yet the builders were doing actually quite well. They will have improved year in 2023. And furthermore, if you look at some of the publicly listed large home builders, their stock prices have been on a boom, 50%, 60%, 70% higher in just 12 months. So if you had a little cash around, invested in home builder stock, you would have done very well. What explains for the difference between realtors and home builders? Because our industry is the same. We always move together. In fact, there are many husband and wife team who are, one is a realtor, one is a home builder. So what explains for the difference between the builders and the realtors when everything should be moving together? Well, the answer is the following: inventory or lack of inventory. On the left-hand side, it is the inventory coming from the multiple listing service, what the realtors see. And what the realtors have been seeing is historically low inventory for the past couple of years. Half of the level compared to pre-COVID, 2019, before that ugly virus came to the country. Right now, we simply don't have enough inventory. While on the builder side, they can simply create an inventory, build a home. I mean, sometimes there is difficulty like lumber prices fluctuating, trying to overcome some regulation, trying to find the subcontractor. But once home is completed, they can make a sale because they can create inventory. So as you can see, relatively speaking, builders have high inventory while the realtors are constrained with low inventory condition. This is the local market statistics that I took directly from your website. A very good job by the president in terms of assuring that the members have all the access to the latest information. So go to the website. So this is for Dane County, I guess the larger county within your area. And sales were down 19%, which is essentially the same as the national trend. So following the national trend. But look on the right side, prices, what your clients are experiencing. Prices increased 6.5% last year. So even though the realtors were having difficulty about business opportunity, be confident in that your clients, 1 year ago, 2 years ago, 5 years ago, whenever they bought, they are enjoying rising home prices, housing wealth, so they're all enjoying that process. So homeowners are smiling, even though the business environment has been quite tough. Let's look at another county, Rock County. Is another important county in your region. Sales were down only 13%. Maybe there was a little more inventory compared to that. I mean, the month supply is very, very tight condition, but the little less of a decline in Rock County. Prices are also up. And also just this three counties, Adams, Juneau, Monroe counties, sales were also down 11%, which is less of a decline. But look at the prices. I put in the red box because this is a 12.9%. Maybe this increase is due to the affordability. It's much more affordable in Adams County, Juneau County, and Monroe County. So among people who have a little more flexibility to work from home, they don't have to be so close to Madison, they don't have to be so close to Milwaukee, they're saying, I'm going to buy a larger home at a more affordable price further away. So maybe the affordability is really leading to less of a decline in sales, but also a little bigger price appreciation. It's still affordable in relation to Madison, but more price appreciation. So affordability is impacted by mortgage rates. Red line or orange line is the average mortgage rate in recent years. This graph begins from 2019, before COVID arrival. So you can't even say the beginning part of the graph is normal. Maybe that's the normal condition. Well, today we are much above normal in terms of interest rate environment. The middle of the graph shows the early years of COVID. The blue line is Federal Reserve policy. The central bank here in Washington, few blocks from where I am standing, they determined the blue line, Fed funds rate. And essentially, the central bank went to zero interest rate policy when we were locked down. We didn't know what was going to happen. So it was a zero interest rate policy in the hopes that other interest rate also decline. And mortgage rate went down to 3%, 4%, which your clients took advantage of or refinanced into those rates. And that's partly the reason why we are lacking inventory. People are loving their 3%, 4% mortgage rate, and they don't want to give that up. Just consider a homeowner who, say, bought 2 years ago and now considering, well, what is that neighbor right across the street? The house right across the street is very similar to ours. If one wanted to sell their home and buy the home right across the street at today's mortgage rate, their monthly payment would essentially double. And that is why they are not doing so. So that's why listing activity is very low, hindering sales activity. This chart is also showing that in addition to low inventory, affordability has been hurt by rising mortgage rate when the Federal Reserve aggressively raised interest rates from about 18 months ago. And the Fed had to do that because they felt embarrassed. Embarrassed in a sense that one of the job of the central bank is to make sure that the dollar is a dollar, not lose value in any great way. But if you remember 2 summers ago, you went to the grocery store and you came out angry. You said they took my all cash, inflation rate was very high, and we had high inflation. Federal Reserve was not doing its job. That's why they have been aggressively raising interest rate. One good news on this chart, look at the orange line at the very end. It's coming down. The blue line is not coming down. Blue line has not changed, but the orange line, mortgage rate, is coming down. Why is that? Because the Federal Reserve changed their communication. It is indicating that 3 interest rate cut is likely this year. My opinion is that it's going to be more like 4 or 5 rate cuts, which I will go into the logic as to why. But the bond market, mortgage market, is already pivoting in anticipation of the future rate cuts. So mortgage rate today in mid-January is meaningfully lower compared to October. October, 8%, today 6.6% average. And here's the pivot on the 10-year Treasury yield. So once the Federal Reserve changes communication, you can see the pivot on the 10-year Treasury yield. And 10-year Treasury yield is the benchmark that determines many interest rates, including mortgage rates. One of the first thing I do when I wake up in the morning, go to my app, see what the 10-year Treasury yield is, because I want to see the direction of the mortgage rate. So 10-year Treasury yield decline, mortgage rate will be lower. 10-year Treasury yield rise, mortgage rate will be higher. So 10-year Treasury has pivoted down in the past couple of months, bringing the mortgage rate down. But one potential hindrance to any further decline in the 10-year Treasury is what's happening here in Washington. Massive federal budget deficit. Blue line is government spending on everything. People coming from the southern border, well, there's some expenditure involved once they come into the country. I'm sure it's not a massive sum, but still it's adding to government spending. Social Security spending, national defense spending, infrastructure spending, Section 8 voucher, everything combined. Blue line would represent that. While the red line shows tax revenue coming into Washington. So tax revenue is below the government spending. What is interesting is that in 2020, the first blowout spending, 2020, the blue line really popping higher. You can say that's justified. It was COVID. We didn't know what was going to happen. So the fact that government went big, you say, well, maybe that was justified. But we are well out of COVID. But we are spending as if we are still in COVID, as you can see. Maybe it's not a COVID spending, maybe on something else, but spending level is just as high or even higher than in 2020. So large budget deficit. Let me go back to the prior chart. 10-year Treasury yield pivoted down, but can it go down meaningfully further, or will it stop, or even go back up again? Well, some people are getting a little nervous about this budget deficit situation, where somehow it seems to be just kicking the can down the road. They cannot agree, so they do something called continuing resolution, meaning say timeout. Oh, let's do the same thing as we did last year. Let me do one cough. My throat is dry. Excuse me for that. So continuing resolution means this chart gets replicated again and again. So no major progress on this chart. So let's see if we can get something on that. Let me now turn to the job market. So the job market looks like the following. Right before COVID, the little disruption that you see at the beginning is the lockdown. But once we were out of the lockdown, you see the more jobs, such that now we have 5 million more Americans working compared to pre-COVID, 5 million more Americans. So that is a good trend. But if we look at the change in job, how many new jobs with each month, you can see that the number is beginning to be a little lighter. 2024, presidential election year. If this was to turn negative by summer or autumn, it is very bad news for the incumbent party. But if this number stays positive or even begin to strengthen, it will be a good news for the incumbent party. And of course, Wisconsin, key swing state, you will be bombarded with all this television ad, how bad Trump is, how bad Biden is. So you're going to be inundated throughout the September October time period, but job numbers, could move some of the voting decision among 1, 2, 3% of the population. Let's look at the job comparison between states. Wisconsin, people in the back may not be able to see it, so let me read a number to you. 1.4%. That means in Wisconsin, there is 1.4% more job today compared to pre-COVID. So I'm comparing with pre-COVID, 1.4% more job in Wisconsin, which is better than Minnesota, 1.2, or Iowa, 0.6, or Illinois, or Michigan. Only Indiana is one of the outperformer in the Midwestern states. But the dark blue that you see, essentially Florida, Texas, and the Rocky Mountain states, they are top flyers. They are massively creating jobs. For example, in Texas, 9.2% more job compared to Wisconsin, 1.4%. So Texas, in essence, are doing, 7 times faster job creation compared to Wisconsin. The few orange states, they are still down. District of Columbia, where I am, it is down 2.7%. So DC is still negative condition. And let's look at the timeline of the jobs in the greater Madison metro market, which would cover several counties. I don't know if this directly matches up with your association counties, but it's several counties around Madison. So from 2017, 3 years before COVID and 3 years after COVID. In the middle is the lockdown. So before COVID, in the 3 years prior, Madison was adding about 20,000 jobs in that 3-year time span. Now it is a little above pre-COVID. So in Madison, little above 120,000 jobs now. So not only fully recover, but a little more, but not greatly. So it's just modestly above pre-COVID condition. And looking at the Janesville, Beloit, I hope I'm pronouncing it correct. Looks like a French word. And of course, people in Wisconsin, you have some, people, I guess, from France a long time ago, moving down the Mississippi River, and then many German heritage, because you have a lot of beer brewers. Anytime you see a lot of beer brewers, the Germans came there. So in the Janesville, Beloit area, similar to the Madison in terms of the trend. So there was some job creation pre-COVID, then lockdown, now a little above pre-COVID condition. Let's look at home prices. Home prices in Wisconsin is doing well. 47% price increase in 3 years. 47%. Again, darker blue states have a faster price appreciation, light blue a little lagging behind. So Wisconsin is doing better than Minnesota, Iowa, or Illinois. So, actually meaningfully better, 47% versus Illinois of 35%. So in terms of prices, it's doing better. And I think this could be due to the work from home phenomena. Because if you look at the top right corner, state of Maine, they are one of the top performer of price increases. They're not that great in terms of job creation, but people from Boston are buying homes in Maine. People from New York City is going to Maine, looking for fresh air, more elbow room, maybe less crime. And they are essentially saying, if I can work from home, among those few people who are in that situation, they're saying, I'm going to get out of the city. And maybe you are seeing this from Chicago phenomena. People who are saying, well, if I can work from home, why am I near Chicago? I'm going to go to Wisconsin. So maybe this is why you are getting that price bump up, better price bump up in Wisconsin. Because of price increases, homeowners are continuing to build wealth. Your clients are super happy. They're building wealth. You may want to call them just to say hello, because subconsciously you want to remind them why they are happy. They bought a home with you, and that's why they're happy. And just in case they find a friend or a business colleague who need a real estate service, they can refer to you because they are in a good shape, very high wealth accumulation. Renters is in the blue. You have to squint your eyes. It's hard to see because their wealth is hardly nothing. So this includes cash in the bank, 401k, and housing wealth. And for many middle-class Americans, it's really about housing wealth. That's the situation. So the renters, they're just spinning their wheels. And a chart that you may want to that definitely show to potential first-time buyers who may be hesitating. Just ask any home buyers in the 1990s. They purchased their home when the mortgage rates were 12%. Yet if you were to ask, was that a good decision? Nearly everyone would say, yes, it was a great decision when I purchased a home back then, because in America, you can always refinance downward. One thing that we're also working on here in Washington from the NAR advocacy position is that many people, home prices have risen so much, now they are exceeding the capital gains exemption. Single people, $250,000. Married couple, $500,000, something that you all know. You sell a home, you don't pay tax. where some people may have exceeded this amount now because of price increase, and they have to pay tax, and they don't want to do that, so they don't list their home. Well, we are talking to Congress to say that this figure has not been changed for 25 years. 25 years, this capital exemption, let's index to inflation out of fairness. Price of movie ticket was very low 25 years ago. Price of hamburger was very low 25 years ago. And the capital gains exemption, well, that has not changed in 25 years. Can we simply index to inflation so people can sell their home without paying that capital gains tax? And let's just remember also, 90% of tax revenue coming into Washington, 90% are paid by homeowners. So homeowners are already burdened or large tax payment, so they should not be additionally burdened with this additional capital gains tax, something that we are working on. So let me go to the forecast and then what you can anticipate. So mortgage rate will be between 6 and 7 most of this year. I mean, it's already at that level. And towards the year end, I think it could actually be closer to 6%. And 3 key reasons. One, there's a massive apartment construction, and therefore rents are no longer rising strongly. And that will hold down consumer price inflation, which then will allow the Federal Reserve to cut interest rate because inflation is no longer an issue. Second, let's discuss a topic. Many small-sized banks, they're under stress. Remember Silicon Valley Bank, they went under, and a couple of other banks went under. Well, that could have been many other banks, except for the fact that Federal Reserve put a special credit line after the failure of Silicon Valley Bank to prevent more failures. They cannot continue this special credit line forever. At some point, they have to let it go. And only way to help community bank balance sheet is to cut interest rate. So by cutting interest rate, it will help community banks. And third point, something esoteric, spread with government bond, the benchmark 10-year treasury, and mortgage rate. What a better illustration is this graph. The spread is always about 2 percentage points. I put that circle to say abnormality. Sometimes we have abnormal condition like today, but there are conditions in place to say this abnormality should steadily disappear this year. Not immediately, but maybe by the year end, it will steadily disappear. What that means is that this morning, 10-year treasury, 4.1%. Corresponding mortgage rate today should be 6.1% mortgage rate, 6.1, but we don't have 6.1. Rather, we have 6.6. So there is a room for mortgage rate to decline once this spread disappears. So once the interest rate comes down, what happens? Well, we know there's always more buyers. We know that. But I think what would be unique, something that you should be on the lookout is more sellers listing. Homeowners will not give up their 3% mortgage rate for 8%, but maybe they will do so for 6%. Why? Life has moved on. 7 million newborn babies. People need a larger size home. They need to list their small property and trade up to a larger one. 3 million marriages. Some of these marriages are for older people, second, third marriages. 2 people get together, they list one of their properties. Divorces lead to more listings. 7 million Americans turn 65. Maybe they want to trade down. So we have people who need to trade up. Now, maybe there are some people who need to trade down. Life cycle, there are deaths every year. And the jobs, 50 million job switches over the past 2 years. So among those job switches, maybe some people have remote work and they remember growing up their fond times in Wisconsin, and they said, my job is in San Francisco. I grew up in Wisconsin. Now my job is remote. Maybe I want to go back to Wisconsin. So I think this will also lead to more dynamism. My final chart is this. 2023 was difficult, no doubt about it. The blue is builders. Builders actually improve sales. But the red for the realtors, very difficult year. But in 2024, my motto is saying home sales will be rising. Builders continue to increase and existing home sales rising 13%. Now the reality could be 20% or 10%. I don't know. It's like forecasting snow. You see the condition as to why the snow would fall. Is it going to be 4 inches or 8 inches? Well, we have to wait and see. So we have to wait and see. But I think the Wisconsin is actually in a little better position. You saw the price increases more stronger among the Midwestern states, saying that if there is a remote work possibility, people are choosing to go to Wisconsin. So thank you very much for giving me some time to share my thoughts with you all. Worst is over. Thank goodness 2023 is over. We're starting the new year. Early week data this year is already indicating there's a stirring of buyer interest, but I think there will also be some stirring of potential listings coming onto the market as people have life circumstances have changed. So again, thank you very much.
All right. Do we, anybody have any questions for Lawrence? Thanks, Lawrence. Questions?
Josh, my only one was with Dr. Young's comment about job gains being lower in Wisconsin than Texas, for example. Is that job creation or openings created by people moving away or to? I don't know if you could hear that.
Lawrence, did you hear that?
Yes, I think I heard that. So that job figures, Texas, 9%. That means that in Texas, there are 9% more people receiving paycheck now compared to pre-COVID. So 9% actually working, receiving paycheck, while in Wisconsin, it's only 1% more.
So new construction or new home sales, is that based upon closings or is it based on permits that have been pulled?
New construction, wondering if that's based on closings or permits pulled.
This is based on the actual new home sales contracts. So newly built home under contract. I know there were at times where the contract got canceled, so it did not lead to closing, especially when the mortgage rate suddenly shot up. But once the builders readjusted, maybe even a price discount or mortgage rate buy down to induce buyers to come, then it got into another contract. So overall, the new home sales are rising. So it's not permit or starts; it's actually new home sales contracts.
I have a question as to why the community banks were blindsided by interest rates.
Why were the community banks blindsided by the interest rates?
Yes. So the community bank, the large banks like JP Morgan, Wells Fargo, Bank of America, they meet with Washington regulators frequently, and they have to undergo something called stress tests. That's to assure that the banking system is safe and sound. We want to make sure that all the banks are in a safe, sound situation. So stress test essentially means that the regulators would essentially tell JP Morgan, hypothetically, if the interest rates were this high, let me see your balance sheet. So they look at the balance sheet and they say, oh, JP Morgan, you're going to be in trouble if the interest rates were to be this high, so you better readjust your portfolio a bit. So, maybe it's unfair, but the big banks were, in a sense, pre-notified about the interest rate hikes, while the smaller size banks were taken by surprise. And that's why the small size banks are in much more difficult situation compared to larger banks. And furthermore, small size banks have more exposure to commercial real estate, like in the office loan and others, and commercial real estate prices have come down. Residential prices rising, but commercial real estate prices have come down because of higher interest rate, and community banks have exposure to those.
Thank you. All right. I think that's all we have for questions, Lawrence. Thank you very much for joining us today and providing some great insight.
Great. Have a wonderful day, everyone.